So I'd like to welcome everyone to this 8th Intelligness virtual event, the Future of DeFi Summit. My name's Ryan Hanley. I'm going to be your host for the following 2 hours, the Head of Product for DeFi at Elwood Technologies. Just to intro the event, just to set the scene, I think we've seen an incredible cataclysmic event over the last 2 years within decentralized finance. As much as 2020 seemed to be a lot of kind of entering of the market with a number of different food coins, a large explosion with quite experimental technologies. I think we've seen real maturation over this past year, seeing a number of traditional instruments pulled into decentralized code and scaled from the likes of DYDX to Uniswap, reaching equivalent volumes to that of Coinbase within certain pairs. And with the evolution of some of the incentives around DeFi, especially in the passing months, I'm delighted to have an esteemed panel of speakers and also panelists who will go into a number of these different areas. Before starting off the event, I just want to make it very clear that we'd love to have this as an interactive event, so please do be active in the Q&A if there are any things which don't quite make sense or you'd like us to go into a little bit more. I'd also like to give a shout out to our gold sponsors, who are Elwood Technologies, who are helping to host, and also some of our media partners, so Cryptoland, DeFi Prime, Fintech, IMTN, Inside Telecom, ICO Holder, Crypto News Z, Fintech Finance. For those of you who have potentially registered or need to drop out at various times, the whole event will be recorded and we will be making that available and sent out to those who have registered. So without further ado, I'd love to introduce my first speaker, and who that is Ian Taylor, who will be speaking about digital currencies, regulation, and policies. Ian, I hate reading out people's bios. Would you perhaps like to give a short introduction in terms of what you've been up to within DeFi the past couple of years?
Sure. Thank you, Brian. Pleasure to be here. And thank you for inviting me along to speak today. Yes, so I am the Executive Director of CryptoUK. We're the UK's trade body, which has 100 members. We were formed in 2017. Our main objective is to advocate for fair and balanced proportionate regulation, focused in the UK, but naturally, as this industry is global, we work across other jurisdictions with other trade bodies, intergovernmental agencies such as FATF. And when I go into the detail of my speech, I'll dive into some of the issues there. And yeah, so traditionally, I've been involved in crypto in a centralized space. When I started working on the policy side, helping governments understand what's going on, working with the industry. And so in the last couple of years, we've seen a great amount of building and total value locked in, assets under management going to DeFi. Naturally, as a crypto user myself for many years, was peaked during the DeFi summers. I have been an avid user of decentralized finance since then, and are working with a number of market participants and also with policymakers to help them understand what's happening in this new arena, learn about new corporate models such as DAOs, and how we can work together as a society to balance the risk of consumer harms without stifling innovation.
Amazing. Yeah, a much needed role, especially as we have Elizabeth Warren's comments this week around DeFi potentially being the shadiest part of cryptocurrency. So I'm sure the regulators you're speaking to probably have a bit of a spectrum in terms of how they're viewing the market. But of course, from some of those comments, it seems like education of regulators is still something which we very much need to push. So Ian, I'll let you continue and kick off with your presentation.
Thank you, Ryan. And yes, interestingly, US members of the House and also heads of different departments are quite vocal, and we've had much commentary out of different agencies in the US. But I'll focus the first part of my presentation on the UK and what policy and regulatory clarity we have for crypto generally. And then I'll wrap up with sort of what we've seen so far in terms of commentary coming in regards to DeFi and what I believe the industry can do to help improve on providing support to governments and what regulatory clarity should look like. So yeah, CryptoUK, what are we about? We're established in 2018. As I said, we have 100 members. Our mandate is to promote accountability and self-governance of our members. We have a code of conduct that all our members adhere to. And we have both CeFi and DeFi participants involved in our community. We educate, inform, and advocate, not just in the UK. As I said, we work across the globe with other trade bodies, not just crypto or blockchain trade bodies, but traditional finance as well. And we engage with global industry participants. One example I can give is just earlier this morning, we're invited by Her Majesty's Treasury to speak at the G7 ransomware workshop that took place today. The UK was hosting that, the Home Office, and so we got the chance to provide in that forum how we see public and private partnership with our members to be able to stop criminals using Bitcoin and other crypto assets as a means to extort through ransomware. Our members consist, as I say, we have institutional members, some large organizations such as Bitpanda, Revolut. We have lots of the crypto native exchanges, part of our membership and on and off ramps. We have accountants, we have lawyers, we have credit card issuers, and we're seeing greater institutional involvement in the community. So right now in the UK, the regulatory landscape is pretty much a three-pillar piecemeal approach. We know from consultations and our discussions with Her Majesty's Treasury that the approach in the UK is similar to how it always has been with financial regulation, is a wait and see approach, and generally takes the guidance issued by the intergovernmental departments. I mentioned FATF before, but also IOSCO and BIS, Bank of International Settlements. So the three core pieces of regulation are: number one, money laundering. Economic crime naturally is the first use case that policymakers want to address, and rightfully so. The community supports this, of course, and in the UK we have the EU AMLD 5, Anti-Money Laundering Directive 5, excuse me, rollout, which the FCA started just prior to Brexit. So that means that all crypto asset service businesses have to apply into this licensing regime to effectively conduct the same level of due diligence on customers that financial institutions, lawyers, and estate agents do when you onboard new clients. This particular first piece of regulation has been fraught with a lot of issues, both in terms of the FCA lacking resource, understanding, and also on the other side, the industry lacking the skills, the knowledge, and the experience, especially for crypto native business, and you're spending all your time developing and building a product or solution, putting in place process and policy and procedure, and reporting governance models to protect against illicit finance is something that you haven't experienced previously, because this industry, as we know, is largely unregulated. So that's in play, right? Mm-hmm.
There's been a lot of noise, obviously, with this new UK regime on this. I mean, I understand the numbers are that we have maybe 26 now firms which have managed to be able to get approved under that ML5
mm-hmm.
license. But I think that's maybe out of, I know I'm pulling figures out of the air, but maybe 300 who have potentially applied. Would you be able to maybe break down some of the, the specifics in terms of, why there's such a disparity in terms of number of applications and guys who are actually able to get through? I think of those 26, 2 of which are the same company as well. So really, it's actually just 25 who have managed to get through.
Sure. Well, naturally, I can speak to this. This has been one of our major focuses in the last 2 years since the regime started in January 2020. So in summary, when the FCA conducted the initial research, and I was part of that in 2019, they forecast approximately 50 applications. They received approximately 200. We now know that some 50 have been asked to withdraw, which means instead of being rejected, which contains quite a lot of stigma if you have been rejected an application, that stays on your permanent record. What the FCA do is say, look, go away, change this, that, and the other, and come back with a better application. So like a kick in the bum, but not push you all the way down the stairs. And we've seen that with a number of our members who are going away and coming back with a approved application. And so that leaves the cohort of 150. And within that cohort, as you say, received some 20 plus, which is not great, considering this has nearly been running 2 years. However, there are only 4 names, and 2 of them are the same organization, just different legal entities, that were appended to this new regulation regime for about a year. And so what we had companies that had applied and that had the belief that they would have to stop trading come the deadline, which was the end of last year. So now we live in this temporary regime. It's been extended twice to this point. We expect it to be extended again because I believe the deadline's next year, and we still have some 100 or so companies that are there. But the problem we see is not the companies that were grandfathered in, that means they were trading and live when they applied back in 2020, but those companies that don't have a business offering yet in the UK, but want to set up, but they can't start trading until the application has been approved. So you've got the likes of Binance UK, you've got the likes of Crypto.com UK that just have costs. They can't set up their business in the UK. However, that doesn't mean that a UK citizen can't then go and use their .com platform, which we naturally have seen. So it's a bit of a mess, but we have been promised by the FCA that they are beefing up resources, and that has been the case because the majority of that 20 or so has come in the last 6 months since the summer. So I think that's a positive.
And I mean, you mentioned some pretty large names there. Crypto.com, Binance UK, obviously struggling to set up services directly in the UK and relying on obviously reverse solicitation to be able to bring people into other jurisdictions. Would it be fair to say that the FCA are perhaps, in the way that this is structured, favouring slightly larger companies? Because obviously we've now been extended, as you mentioned, a couple of times. I imagine getting these documentations sort of together isn't a trivial affair. It involves resource, it involves external advice from legal entities. Would you say this is somewhat maybe throttling some of the smaller innovative companies from starting in the UK and perhaps moving them further afield?
Yeah, it's an existential threat. And whenever we respond to government consultations, we always, mention this as a key consideration, that this needs to be proportionate, and they do price the applications proportionally. Although that said, the original price is now for the smaller organisation been put up to £10,000. That's the same price for everybody. So that is a problem because that's a heavy lift. Not only, as you say, you have third-party costs, the resource requirement, not just in terms of using professionals, whether it be legal firms or compliance professionals, but just all the time you have to put into the questions that come from the SA. This is a heavy lift, this licensing regime. It is only supposed to do one thing, and that's this particular activity. However, we do know from members that a lot of the time the questions are far more reaching and overarching than just this activity. And you're damned if you do, if you're damned if you don't, from the regulator, because this is the only tool they have to protect consumer harms in the UK, and that's one of their main remits. Their other remit is also competition, which conversely enough, to your point about only allowing the larger organisation through, is a concern that we hear quite a lot. And some people would even say, and this hasn't naturally, the FCA doesn't put this out there, but people would say that it's easier for the regulator to deal with a handful of bigger players than it is to deal with a large cohort of small organisations.
Yeah, I think that's a really fair point. When I used to be managing director of Token Market, we sat in the FCA sandbox for a good 2 years, and we've sort of finally got to the end of that sort of state. But with obviously something which is so new and changing and so volatile, It's very, very hard for the regulators to keep up, I would say. And I imagine also, with the kind of the principle-based risk aspect to a lot of AML within blockchain, I think is very, very hard for them to, set specific rules in place, which would make it a little bit easier to follow, just because of the speed of innovation means they need to take that, that slightly more flexible route as and when a client is actually coming up and looking forward. So have you maybe seen perhaps more, let's say, structured regulation within other regimes, where you're seeing, companies who potentially would have liked to go through the UK regulation, but have maybe been priced out somewhat? Are we, seeing those flows going specifically to certain other regions?
Yeah, it's unfortunate. The lawyers tell us that there is a lot of jurisdiction shopping taking place. And we do a lot of work with government departments in the UK. For example, Department of International Trade invite us to calls with overseas entities that would like to set up an operation in the UK, that's a blockchain or crypto operation. Naturally, the UK has a great pedigree for financial services and fintech, capital of the world. So we have great access to resource, whether it be devs or legal expertise. And the main question is, and that's why we rock up to these conversations, is about the regulatory clarity in the UK. And the word on the street is that the FCA money laundering regime is a big blocker. People do not want to come to the UK because they can't start trading and they don't know when their application will get processed. And that's a big risk. And FCA know this, Her Majesty's Treasury know this, politicians know this. So things are improving. And we're launching, CryptoUK is going to be the secretariat for an all-party parliamentary group, which will be titled Crypto and Digital Assets. That goes live. We had the inaugural meeting a few weeks ago, so that will roll out in the new year. And within that group, we'll be able to work with members of parliament, both in the upper and the lower house, to really help move the needle here and make the UK a go-to place for crypto businesses, whether CeFi or DeFi, because we believe that we have a great opportunity. And this is exactly what the politicians want to hear: create jobs, tax revenues, and that's something that we know that crypto is doing.
Fantastic. And in terms of sort of what you see on the horizon in the next 12 months, obviously, getting closer to government and other policymakers to be able to obviously show how the UK can potentially be, a real sort of guiding light in some of these new technologies. How up to speed on DeFi are the regulators at the moment? I mean, from the pace of innovation, even those of us who've been in this industry for 4 years find it hard to continue to follow, the various instruments which are being replicated, some of which we've never seen before, only ever been able to be created within smart contracts. How have you found the kind of the understanding of some of these concepts from a regulatory aspect, or are they still very much looking solely in the lens of kind of AML, where you're able to see KYC from more traditional centralized exchanges?
Well, I think we need to walk before we run as a jurisdiction, and it's just too early to start thinking about policy and guardrails for DeFi. For me, when I got involved in the policy space in crypto in 2017, that's where we are now with DeFi. We're just starting to educate. So I presented to HMT's crypto policy team that are writing the regulations on stablecoins and also on financial promotion. So that's the other two pillars to the three pillars of the UK. So all crypto asset promotions will be regulated under the financial promotions order next year. That statute instrument rolls out. And then stablecoin issuers will also be regulated, similar to e-money institutions, but there'll be a slight difference there because it's not a perfect fit in terms of that type of payment regulation. But yeah, the only comment that you would have seen out of government is in that stablecoin consultation, which closed back in March of this year, 2 little paragraphs, less than 50 words, asking for industry to engage. And so I did. So I went along to Treasury and said, look, here's a presentation. This is what stablecoin is. This is what an AMM is. This is what a liquidity pool is. This is what a long-tail asset is. I gave them some numbers, total value locked in, told them what the biggest players were, whether a DEX or a lending platform, what to make a DAO, how does that work? And that's where we're at. And I can tell you that it's just too soon to start talking about DeFi. with policymakers, because when we had our inaugural meeting, we had about 10 politicians there, chair, co-chair, and officers of the group. And the main question they said to us, and the main thing they want us to do for the first 100 days, is education. Just really help them understand what different tokens do, who are the market participants, what are the issues we're facing in the UK right now that we need to address. So trying to regulate DeFi, which unfortunately FATF tried to do in their guidance earlier this year, but unfortunately we saw the delayed guidance they updated the definition of a VASP, and also stopped the blocking of peer-to-peer payments to non-hosted wallets from a centralized exchange, or in FATF's terminology, a VASP, which was down to pressure from the public sector. And so that's all the good work that other trade bodies, including ourselves, did, and worked directly with it, helping educate policymakers. But there will be a time where DeFi has to consider itself in terms of regulation. And it's a bit of an oxymoron to go around town saying code is law, we don't need regulation. Because all it will take is as a test case in court where smart contract falls over and funds are locked up, and then the person who has the clout and the power and the resource to take the platform to court, and then we'll see some clarity. And yeah.
So, I mean, just because I know we've got quite a spectrum of people in the audience, I mean, maybe it'd be useful to just unwind that a little bit in terms of non-custodial wallets and how that was kind of bridged by FATF and why that was a little bit of an issue, because obviously I think that's it's quite advanced for some. So maybe could you sort of summarize what some of the issues were there which got raised with that? I think maybe that first FATF report, and then obviously how that's maybe evolved after some of the industry feedback.
Yes, so the initial recommendation 16, the so-called travel rule guidance coming out of FATF, was in 2019, and they've incremented this guidance over the last couple of years. And then in March of this year, we saw an updated definition of a VASP, which is a virtual asset service provider, or in MiCA, the European regulation, they call it a crypto asset service provider, which the definition is quite broad. You could be an exchange, you could be a custodian, you could be some sort of other market participant. The problem with this additional guidance was it shoehorned in non-hosted wallets or non-custodial wallets. And a lot of the time, these non-hosted wallets are just pieces of code. It's like an app, effectively, that can live either on your phone, on your desktop, wherever whatever device you use. And so what then that would result in is the developer of the app would then start having to behave like a centralized entity in collecting personal information about the person that's sending the funds, when in fact all of the non-hosted wallet developer is doing is building a piece of infrastructure. And then when they've completed that part of the supply chain and launched that into the market, then that's it. They don't touch the customer sending funds. And so that was an existential threat to the industry. So we all rallied together. Ourselves, CryptoUK, worked with Blockchain Association in Europe. We worked with the Blockchain Association in Washington, DC. We worked with Access, the work out of Singapore with their monetary authority, to develop a, if you like, piece of thought leadership and a letter with a host of questions and guidance back to them. And so we as an industry saw that this additional guidance was amended, which doesn't shoehorn in non-hosted wallet, which is good. However, I think this is a nod to DeFi that you're on watch, because there is an existential threat. If you're a policymaker and your main job is to protect against illicit finance, there's no onboarding on a decentralized exchange. There's no collecting of personal data. So it is seen in government lenses as a way for people to launder money. So,
I mean, this is a great area to go into, obviously, as we're kind of seeing these worlds combined, right, from sort of an institutionalized finance and, let's say, more retail. You know, the major concern there, as you've highlighted, is the lack of KYC, right, on a non-custodial wallet. So not understanding who is behind that. Is that maybe something that needs to be explained a little bit more to regulators in terms of how KYC at one endpoint will potentially actually happen once someone looks to come out into fiat finance? Is that something that they're sort of struggling to grasp a little bit, just in terms of the fungibility of some of these pools and the kind of the analytics which are actually available in this quite open scenario where wallets which interact with smart contracts actually have to be the receiver of funds as well?
Yeah, there's quite a lot to unpack there. And what we do is, for example, it's our job to educate policymakers into what the benefits of the technology is. And you mentioned blockchain analytics, and also there's much development going on in ways to conceal privacy, but also bake in customer due diligence, bake in customer data to, say, a token, or to, say, sending a message through zero knowledge proofs, for example, and other developments in cryptography, such as homomorphic cryptography. So what we've done is, when we responded to the HMC, Her Majesty's Treasury consultation on the travel implemented only in the UK, because they're going to do it because FATF have issued their guidance, is that we took along a whole host of our members that are involved in this space, technical people, compliance people, legal people, developers, to help them understand some of the great work that's being done in this space. And so it's just at this really early stage of policymakers trying to fit the round peg into the square hole, using the traditional method they have in finance, and finance generally, for FATF, who are all compliance experts, understand that, yes, there's a central entity that we can force and control and get them to collect information and protect against illicit finance. But in decentral land, that's not the case. We're talking about code. So we need to come up with new models. And I've spoken to a number of decentralized exchanges, not just on Ethereum, on Polkadot and other chains, where they are already solving KYC at the onboarding level, and also enabling sharing of data across different platforms to protect against economic crime.
I think you made a really good point, and I'm going to bring up Christine's question here, which says, in some cases, for example, Circle can do white label KYC. Is this something that can actually be applied across the board? It might be interesting to go into some of the nuances of KYC within the kind of the traditional realm, because obviously, as we have sort of opened up this cross-border way of transacting, KYC can become a little difficult to have a universal ID for. Did you want to perhaps go into some of those kind of areas? Because I think this is commonly sort of brought up, is that, well, why don't we just have a universal KYC ID? But in practice, maybe that's a little bit more difficult than it seems.
Yeah, I'm no expert on digital identity. There's lots of good work being done. It's not an easy problem to solve. But what I do know is, when we presented to the G7 earlier today, we had two of our members, Elliptic and TRM Labs, talk to these policymakers who were naturally from all of the major 7 economies, plus folks from Interpol, Europol, FinCEN, et cetera, that we have a great opportunity to follow the flow of funds. Because, for example, Bitcoin is a public blockchain, and you can see all of the transaction history. Even if criminals want to use obfuscation tools such as mixers, tumblers, it's still possible to trace the funds. And what we propose to them is, through public-private partnership, we, now that most VASPs will be doing customer due diligence in a centralized space, we can block funds in real time. So there will be a world in the next year, I hope, where criminals that want to extort using Bitcoin, for example, will see that this is the worst idea, because funds will be frozen. You just need 3 or 4 big cases. And we know that the Colonial Pipeline hack, all funds are retrieved thanks to the likes of TRM and Elliptic working with law enforcement, and the recent hack of the Polychain network. You mentioned stablecoins, so Circle and USDC actually froze tokens. So the hackers basically returned $600 million. There's no way you could use it. And so this industry has, for all its pluses and minuses, is very collaborative and has a superpower that it can move, at light speed to protect these things. So there's just some good examples that we present to government. So hopefully it stops them coming down too hard. And I can't speak for the US. There's many different things that come out there, but in the UK, we're a little less aggressive, I think, in taking action. and have a more reserved balance, and policymakers have an approach of listening to the private sector. Whether we move the needle or not, that remains to be seen, but I think we're doing good work as a community.